What's going on, good people? This video is about risk management and setting some parameters around your trading to help you lose less money. Got a request from True on YouTube. Could I put out a risk management video kind of detailing my thought process and how I like to manage my risk? So let's jump into it. The first thing you need to ask yourself is, what type of trader are you? Do you thrive off hitting home runs? Making $1, $2, $3 off every trade? Is that what you need to be successful? Or can you live with just some base hits, just getting on base, 20 cents here, 30 cents, 80 cents here? Until you are actually able to get that home run trade, can you live with that? And once you define the type of trader you are, that's going to help you actually put a plan in place to keep you from losing money on every single trade. So for me, I'm a base hit type trader. I just like to get on base. I like to see my account grow little by little. I don't need big trades, to feel myself being profitable. I need actually to see myself getting on base, seeing the trade work, taking a little 20-cent hitter here or a little 50-cent hitter there, and letting that profit add up that way. And that's how I've been able to sustain my trading. Now granted, it didn't start off that way. It started off swinging for the fences every single time and striking out every single time. And granted, you can be profitable that way. If your winners are bigger than your losers, you can be profitable. But for me, it doesn't work. So I like to hit, base hits. But most importantly, you have to trade within your means. You can't trade stocks that you can't afford. It's like, I don't trade Priceline. I can't afford $1,000, stock. It's just out of my means, out of my realm of trading. I don't trade Berkshire Hathaway Common A stock. It's just too expensive. So look at what you can actually afford to trade and then trade those stocks. It's more than enough stocks or futures or commodities or whatever it is on the market that you can actually trade and be profitable. And then set parameters. For me, I would not lose more than $500 on one trade. Now, that doesn't mean I haven't lost more on one particular stock. I may place 3 or 4 trades on the stock, and that total may add up to be $1,800. I think I did that last week. So I ended up losing, $1,800 on the stock, and then was able to find a U-shaped pattern form later on in the evening and make some of the money back. But on one given trade, my stop max loss on one given trade is $500, and my max loss on the day is $2,000. So if it's 9:45 and I've lost $2,000, then that's it. I'm done. Get up from the computer, go do something else, and get back at it the next day. And I never risk more than 10% of my total account balance on one trade. I'll never put all my eggs in one basket. The opportunity will come while you're in a trade where something is moving. You got to have some liquidity. You got to have some money sitting aside to where you can get in those stocks, get in those trades that didn't take place at 9:30, may come around at 9:45 or come around at 10:30. But if you have all your eggs in one basket, it's going to be kind of hard to leverage those resources. And you have to maintain the 1 to 1.5 risk to reward ratio. If you're going to risk $1, make $1.50, make $2. That should be your goal. You should never risk $1 just to make $1. You're spinning your wheels. And actually, if you do that, you're actually losing money because you got to pay commissions. Or some of you may have platform fees, or trade idea fees, or other news feeds that actually cost money. So if you can keep Keep your fixed costs, the things you know you're going to spend every day, the things you know you're paying for, whether it's internet service, power, trade ideas, whoever, keep those things to a minimum. That'll keep your profitability at a reasonable level. And aim for being a successful trader. Aim for trying to take 4 trades and having 3 of them to be a success. Aim for that. It may not happen every single time, but if you at least put that out there, put it on paper. Hey, my goal is to be in that 75% range at the end of every trading day. Then actually you're doing better than 90% of the people out there trading. You're basically trading like a professional if you can hit that target. Now, like I said, it may not happen every day. You may have some days where you're only 50% successful, but you ended up making $1,000 or you ended up making $500. So at the end of the day was good, but that just means you need to execute a little better, work on the execution process. So let's look at an example. Let's just say hypothetically we have 1,000 shares. $1,000 sitting in the account, which gives us $20,000 worth of buying power, and we want to trade Snap. And Snap is currently trading at 14 bucks. So first you have to ask yourself, how many shares can you buy if you have a $20,000 worth of buying power and Snap is trading at 14? Well, it's simple. You can only buy 1,000 shares because if you don't want to tie up 90% or more than 90% of your account balance, then it means you can only buy 1,000. That puts you around that 70% range. So we take 1,000 shares of Snap, and then we start putting in the numbers. So we're going to enter Snap at 14, and we want to only risk let's say 10% on a stock. That means, hey, Snap can only drop 10 cents before we need to get out. Therefore, our stop needs to be at $13.90. So if we're going to risk 10 cents or 10%, which is actually, $100, 100 divided by 1,000 is 10 cents, means our stop is at $13.90. All right. So what's your first target? Well, your first target should always be the price where you make back what you're willing to risk. So if you're willing to risk $100, your price target needs to be wherever that $100 mark is. So if you enter at 14, your stop is at $13.90, and you're risking 1,000. You have 1,000 shares and you're risking 100. You need to make at least $150 to $200 on this trade to meet the criteria for rule number 3, which is keep a 1.5 or 1 to 2 risk to reward ratio. So my target has to be $14.20. Why? Because at 20 cents, you can actually sell half of your position, which lowers your risk, and lock in $100. So if you sell 500 shares at 20 cent gain, you just locked in $100. So now if the stock goes against you, falls back down, move your stop up to 14, move it up to your break-even price, and now you're locking in $100. It's a win-win scenario. You have to figure out a way to lower your risk in every single trade. If you just keep all your risk on the table throughout the entire trade, you're going to realize that, hey, you're probably not going to make as much money as you can because you're going to get nervous somewhere in that trade. Whether you see a candle that's starting to bounce in the opposite direction, you're going to get that uneasy feeling in your stomach, or your palms going to start sweating, and you're going to be like, hey, I got to do something. And you're probably going to get out of a trade too early, or stay in a trade too long. So lower your risk as a stock is moving in your direction. Take profits, when you can, and scale out. If scaling out actually works for you. Now, scaling out works for me. It may not work for you. You may like to, buy 1,000 shares, let it ride up 50 cents, sell it all at one time, make $500. If that plan works for you, stick with that plan. But this is what I like to do. Now, you can take bits and pieces of this plan, make it your own, chop it down, cut it up, and fit it into your own trading plan. Now, all this is great on paper. But does it make sense when you're actually doing it? That's the question. Does it hold its weight when when the fire is going and you in the midst of a trade? Does this actually work? Well, let's put it to the test and see. We're gonna let's pull up an old chart of Snap and actually see if this works or not. Okay, so we want to actually put this into action, put our risk management into action. Now granted, no two plans are alike, just like no two snowflakes are alike, but every trading plan has a risk parameters around it. Some people have a risk tolerance higher than others, therefore you have to manage those risks differently. But all in all, every trader does pretty much the same thing. So with that said, let's take a look at this Snapchat chart. Here we are looking at a daily 5-minute chart. We have some support from yesterday right here. All right, we said we want to enter a trade at 14, making our stop roughly 1390. So our stop is actually down here. Now generally your stop wants to be where there's an area of support or area of resistance, depending on what you're trading or how you're trading. If you're trading on the short side, you want your stop at an area of resistance. If you're trading on the long side, you want your stop at an area of support. So we know we got support right here around 1395, around this 50 period moving average. We have our stop down here at 1390. So I'm actually going to make this a purple color or green color for the sake of the video. And we want to enter a trade at 14 bucks. So right now the stock is trading at 13.99. So we want to buy 1,000 shares at 14. All right, so we're long Snap at 14. We have our stop right here at 13.90. And let's see, let's put a purple line right here denoting our entry. All right, so our first target is what? Our first target is 14.20. That's where we will make back our $100 at 14.20. We have overnight resistance area, overnight high right here, 14.29. So that could be an area of resistance. If the stock cannot break through that area, then might need to get out. But right now we're going to just see if our stop can hold up. If the stock breaks through, if Snap breaks through this area of previous support, then that lets us know, hey, this stock needs to be shorted. There's no point of going long on this stock. So let's see how this works out. Now when you're trading, you're looking for an area of imbalance. You're looking for areas where buyers and sellers have become exhausted in one direction, and an area of support or resistance is formed, and people are stepping into the stock, pushing the stock in the opposite direction. That's how you make money. It's not all about buying at the high or buying at the low, because sometimes buying at those areas is virtually impossible. It's almost impossible to sell at the high, and just like it's almost impossible to buy at the very bottom. But if you can find areas where support and resistance is defined, there's a clear imbalance in the supply and demand, and either buyers or sellers are picking up the pace, picking up the volume, then you can make money in this game. So we are long at 14. We have some support right here at 13.95. We have our stop at 13.90, roughly 10 cents. Our first target is 14.20. Right here is our first target. At that target, we'll sell half our position, lock in $100, which is the exact amount we're risking Because if the stock hits $13.90, which is 10 cents below our entry, that means, you know, we're stopped out and we lost $100 on this trade. So we want to make that $100 back first. And then from there, we'll look at how we can make more money scaling out as the stock continues to go higher, if it does. So it looks like we got an area of support down here around 14. We just got to push higher. Got volume picking up a little bit, which is great. It lets us know, hey, all these people that sold, you know, were basically people taking profits from either this overnight bounce higher or this previous day bounce higher. Those individuals are taking profits and they're not true sellers. So that's great. Lets us know that this area is actually an area of support. If we can get some continuation through these moving averages up to this 1420 area, we'll look to sell half our position. Let's go ahead and get it in the queue. See what happens. But this is a big volume spike compared to, you know, this candle right here. Sellers sold the stock off, found the area of support. At that area of support is where you want to be buying. You get a volume increase, unless you know other traders are stepping in, or, you know, computers are stepping in, whatever you want to call it. And this trend, this downward trend, has broken, and we want to take some profits off the table at 1420. So we're in good position. So when the stock actually trades at 1420, we'll take profits off. Right now it's at 1417, 1418. And this is how you can manage your risk. Now granted, everybody does something different. So you have to find out what exactly works for you and make it your own. This thought process works great for me and how I like to trade. But it's not the end all be all. So at 1420, we'll sell 500 shares, lock in $100. And if the stock can get up to 1430, we'll sell a little bit more, lock in some more money. All right, so it got filled at 1421. Next, we'll let another 250 go. Our goal is to make either, you know, make between $150 to $200. We already made 100. And anything above, you know, anything above $200, just icing on the cake. You know, our ideal goal is to be have a risk reward ratio to 2 to 1. So if we make $200, that's phenomenal. Anything above that, it's just money in the bank. But it all starts with having a proper setup. Setup was finding the area of support. At that area of support, taking a trade when the opportunity presents itself, not rushing into the trade. So at 1430, we'll sell another 250 shares. And all this, you know, this trade was set up off of sellers becoming weak, buyers stepping into the stock. Therefore, we're trading with the flow. The flow is now, you know, on the long side. So we just, you know, start trading on the long side, taking a long trade and get volume to increase on both of these candles. This candle is actually the telling candle. You know, this tells the story that, hey, after all these sellers, this candle right here lets you know there's no more sellers. There's no more sellers, then there has to be what? There has to be buyers somewhere. Or it could go sideways for a little bit, then, you know, then continue down. But this didn't. It popped up. If the stock decides to roll over, we have our stop. We're going to move our stop up to break even. So moving our stop up to 14 bucks. So if it rolls over, hey, we get stopped out and we make $100. All right, so we're getting a little pullback. Whether this continues or not is all up to, your level 2s and your time of sales. Are there a lot of buyers in this area or a lot of sellers in this area? That's going to determine where this stock goes. But regardless of what it does, we have made money, and that's the whole point of trading, is to make money. There's no point of sitting in a trade 15-30 minutes and you haven't made anything, because you could have put that money to use somewhere else. Okay, so looking good. On sale 250 up here at 430. If it can push up there, lock in some money. We have our stop right here at 14. First target was right here at 20. We locked in $100. Second target is right here at 14.30. Lock in another $75. And final target to be up here at 14.40. Somewhere between 14.50 and 14.40 area. That'll be the final target. I'm just gonna put it at 14.45. If it gets up there, great. So it looks like Snap is pulling back some, which is to be expected. It ran up 28-29 cents. So slight pullback. Like I said, we still have our stop down here at 14, so we're good. Not going to panic. Not going to get fearful or anxious. Just let the stock play out. You already made money. You can either make more if it pushes up, or you can make what you already made if it drops and hits your stop. That's risk management. Your plan should keep you from feeling a certain way about the stock or about a trade. Your plan should keep you from being greedy. It should keep you from being anxious. It should keep you from being fearful. That's what a trading plan does. It's not, your trading plan is not there to actually make you money. It's there to keep you from losing money. Technically, it's just we as human beings, have been trained by society to think that, every trade we're supposed to make $1,000 on every single trade, or, every stock is supposed to go up $1 or $2 every time we get in it. Well, that's not the case. That's not realistic. What's realistic is getting on base, getting a single here and there, and then that's how you win the game. That's how the Houston Astros won the World Series. Everybody didn't hit home runs. Some people just got on base. But then when that pitch was thrown to the right batter who was able to hit the home run, he was able to bring 2 or 3 of his players in. And that's what you got to do as a trader. Just get on base. Some trades are just meant for you to get on base. And then when you're able to hit that home run, you bring everybody else in. And you look up, you got a 2,000 or 3,000 day, in the books. So this stock should bounce higher. If you look at just based off the volume is decreasing. If it continues to decrease, buyers will step back in. You'll see a spike in volume. This area will become another area of support. So as the stock pushes up, if it breaks through 430, this will be our new stop area. This 416, 415 area. We'll move our stop up. take profits up here at 1430 and keep it moving. So we're getting a little bounce off the support area. Now we're just looking for some continuation higher. There we go. There we go. Let's get ready to sell another 250 shares at 1430. And then we will move our stop up to, we actually move it up to what we took profits at right here. We'll move it up to 1420. All right. So now we're gonna move the stop up to 1420. So now we have 250 shares left. Move our stop up to 1420. So now we're basically locking in 20 cents. So if Snap does decide to push back on this last 250 shares, we're going to make 20 cents off those 250 shares. It's all part of risk management. So take some more off at 1440, or somewhere between 1440 and 1450. We can take some more off, or we can just use a Fibonacci extension. And there you have it. 100% gain from this trend. 100% profit would be at 1444. Which that's great. To make 100%, that's phenomenal. So let's do that. Let's remove that. Let's go ahead and sell 100 shares at 1444. Lock in some more money. Move our stop up to 1430. Now we have 150 shares left. So at 1450, we can, we go ahead and flatten out at 1450. Got our stop right here at 1430. And let's see, we may be able to get to that 1450. There we go. Oh, all right. So we out of Snap. Took a long position right here at 14. Stock pushed up to 1420. We sold half at 1420, locking in $100. The stock then moved higher to 1430, sold another half, moved our stop up to 1420. Then the stock pushed even higher, sold some more at 1444, moved our stop up here to 1430, and then exited the position up here around 1450. So it was a great trade. Now let's look at the other scenario. The other scenario is, let's say you buy 1,000 shares at 14, and the stock, you actually hold it all the way up to 1450. All right, that means you made $500. You didn't scale out. You made exactly $500. Same number of shares, and you actually scale out the way I did, make a little less than 300. So that's the gift and the curse. You may make a little less than somebody who does not scale out, but you're locking in profit a little earlier. You're taking some of the risk off the table, and that's the whole point of risk management. So develop a plan that works for you. Develop a strategy that's conducive to your risk tolerance, and trade that plan. I am the Bearded Trader. This is risk management.